Hello, I'm Chelsea Fry with ABRN Magazine. An acquisition-based business strategy is an effective way to grow a company, but it requires a higher level of financial discipline. Brad Mewes is a shop management consultant and author of the blog Supplement, Financial Insight for the Automotive Industry Professional. He uses his weekly blog to focus on business, finance, and corporate strategy, all geared to the collision repair shop. Brad, in your recent blog, Avoid These 4 Common Business Acquisition Mistakes, you explain the dangers of having a lack of focus and its manifestation in 2 key areas, strategic drift and due diligence. Could you explain these acquisition mistakes?
Sure. So there's a lot of press and a lot of research around the dangers of growth just for growth's sake. Often in Fortune 500 type companies, when an executive is doing an acquisition, you'll hear the CEO proclaim, "We're not growing just for the sake of growth." And this is because Wall Street and Wall Street analysts are very attuned to companies that are growing just to grow, to increase their top line revenue numbers without any concern over profitability or accretion. So one of the things that happens if you grow just to grow is you run the risk of buying anything that comes up for sale at any time. So in a collision repair business, this means maybe 1 year a company buys a large 20,000 square foot facility, and then the next year maybe they buy a small 4,000 square foot facility, and then after that they buy a business that's focused on maybe just fleet rental car repair. Then after that they move into mechanical operations, and then after that maybe they buy a bumper reconditioning facility. And so yeah, all those businesses are related, but they're have very different business models as well. So there's a lot of, there's a time element to this, there's a distraction factor, there's a money factor. And in the example I just gave, those businesses may not necessarily fit together in what we call a synergistic way or an efficient way, or in a way that allows a company to leverage efficiencies and leverage cost reductions in an efficient way. So ideally, if you're going to invest in a business for the next 5 or 7, maybe even 10 years or longer, there really ought to be a strategy behind that investment plan that maximizes your return. So in the collision repair space, the opportunity to maximize your returns is really around building scale. And so scale is this idea that allows you to build efficiencies and also to spread your overhead expenses over a wider base of sales. And the result of this is you're able to lower your overall marginal cost. So I know I just threw out a bunch of kind of business school economic geeky words there, but the idea is that economies of scale and efficiency through growth is what will drive the return on your investment. But if you just buy kind of willy-nilly whatever comes across to you, then it's going to be much more difficult to achieve those efficiencies, and you're going to get bogged down in some of these details that will distract you and your management team from executing on growth. And so that's that's acquisition drift, and you mentioned due diligence as well. And so due diligence is this idea that when you're going through an acquisition, whether you're buying a company or selling a company, due diligence is the process of verifying that the targets, that whoever you're buying or selling to, that the target's claims are true. And it's designed to help you find the skeletons in the closet before you buy the house. You go through and you assess the business, and it's a very detailed process. But the dirty secret around due diligence is that, well, no one actually likes doing due diligence because for a buyer, they have to call the seller's baby ugly, and that creates a lot of friction and could potentially blow up a deal. Inexperienced buyers can fumble through due diligence and cause deals to fall apart and ruin the reputations of buyers. So an effective due diligence process is really important to ensure that transactions are being done in an efficient way, a cost-effective way. So, and so there's a bit of, I'm going to make a point here, and it may sound a little self-promotional because it is to a point, but bringing in an advisor where you could help focus your growth strategy adds a lot of value to a buyer and helps minimize the risk. On the due diligence side, it's important to have somebody on your team who has both the financial experience as well as the industry experience to identify areas of concern very quickly and efficiently, and while also kind of understanding the subtle nuances that are involved in getting the transaction done. And this holds true whether you're buying or selling a business, because the due diligence process, if you're selling your business, is often used by buyers to grind down and to engage in additional price or term negotiations. So this is part of the business that both the growth strategy as well as the due diligence side, where we're bringing on outside advisors who have that industry experience, can definitely help streamline those operations, minimize the risk, and improve their overall outcomes.
So how can business owners avoid making mistakes with their post-deal integration plan?
Yeah, so I'm a big fan of written plans, specifically written plans around financial plans as well as operating plans. So an operating plan could include defining the chain of command, developing a communication strategy. For example, when you're going to inform the new key accounts of the business change, when you're going to talk to key vendors, when you're going to discuss this with employees, etc. Also defining specific goals for the management team in terms of sales growth and profitability and overall business management. On the financial side, I'm a big fan of putting together forward-looking, what we call pro forma budgets for an acquisition. So this is really putting together a P&L statement, a forward-looking P&L statement, a forward-looking balance sheet that looks at profits and losses and the actual cash flows in the first, sometimes as detailed as daily or weekly, but certainly on a monthly basis, post-acquisition close. So putting together formal reporting metrics for the management team really helps avoid those month-end surprises for an owner, and allows an owner who is engaged in an acquisition opportunity to arrange for additional financing, for working capital, for example, to fund parts purchases and payroll payments if the cash from the business isn't going to be sufficient, which sometimes it isn't in the beginning stages of an acquisition. So having a written plan, both operationally and financially, is really important. It really minimizes the risk of a business failure or a business surprise post-close. And so, again, this is where having somebody on your team who understands finances, understands operations is really important, and really clarifying what it is that the management team is going to be doing once the acquisition closes.
Thank you once again for your insight, Brad. To learn more and to read the full article, avoid these 4 common business acquisition mistakes, visit abrn.com/4mistakes, or you can visit Brad's blog at sup-co.com. Thank you.